Trading 0 days to expiration, you really have two choices. You can trade index options and you can trade ETF options. And we're going to talk about both first, then we'll talk about the difference between the two. And we'll first talk about why, if you're trading 0 days to expiration, you really have to only trade indices or ETFs. First of all, indices and ETFs diversify away single stock risk. And this, generally speaking, is a positive for any option selling strategies because you avoid, gap risk, you avoid any type of single stock risk. You're basically diversifying all of that away. You don't have earnings, you don't have catalysts, you don't have anything like that can, news-driven events that will drive a particular stock, up 5 to 10% in the intraday. You just don't get that in indices. As an option seller, that's favorable. As an option buyer, you obviously do sometimes want that volatility, but this is something we'll talk about here as we dive into some of the details of trading intraday options. The second thing is that indices rally about 60% of instances, and this just puts statistics in your favor. If you're selling option strategies or if you're buying option strategies, knowing that there's a statistical tilt in one direction certainly helps with choosing a directional view, and we'll talk a little bit about that in terms of back testing of selling puts versus selling calls and kind of what the performance of those strategies look like for these types of 0 days to expiration. But probably more importantly than anything else is the deeper liquidity and the daily expirations. At this point, single stocks don't offer daily expirations, only ETFs and index options, specifically the most widely traded ETFs, SPY, QQQ, IWM, GLD. These are the types of stocks that offer daily expirations, and the corresponding index options for those major indices also offer daily expirations. They offer very, very tight bid-ask spreads. You can basically trade them super liquid at the midpoint pretty much all day long, even as you enter the close at the beginning of the day. So you generally have very low transaction costs trading these because obviously when you're trading intraday, you do need the ability to get in and out very quickly with virtually zero transaction costs in order for these strategies to be effective. And only these products offer those types of characteristics. Okay, let's talk a little about the difference between ETF versus index options. Now, from my perspective, if it wasn't for the size of index option contracts, I would certainly favor index options for these types of strategies because they're cash settled. They're easier to hold into expirations. You don't have to worry about assignment risk, early, exercise risk. You don't have to worry about needing cash in order to, if something was auto exercised, whatever P&L you get at the end of the day, you can hold into expiration and the P&L will simply be accredited or debited into your trading account. So extremely clean for trading 0 days to expiration. You don't have to worry about, hey, I got to close my position at 3:59 before the close to avoid assignment or exercise or any of those types of issues. You also have tax favorable treatment when you're trading index options. There's the Section 1256 contract. That means 60% of it is taxed at long-term capital gains, 40% at short-term capital gains. If you're trading in a taxable account, so they are tax favored from that perspective. So comparing it apples to apples, if you're trading the same size, index options provides kind of favorable tax treatment. Cash settlement, they're European, which means that you don't have early assignment, even though that's usually not that big of an issue with 0 days to expiration. There are some complexities in terms of monthly options or AM settled, so you generally want to avoid trading those. Most of them, in terms of dailies are PM settled, so those are predominantly what you'll be trading. And each contract refers to typically 100 times the index level. Now, my only concern with these types of products for most retail traders is simply their size. SPX is over a $500,000 contract, and NDX NASDAQ 100 is a $1.8 million notional contract. Sometimes that's out of the range for a lot of retail traders. So that's really the biggest issue with these types of index options. Now, both SPX and NDX do offer micro and mini and nano type contracts for index options, but it's important to understand that they're not as liquid. So you can't expect the same amount of liquidity as you would trading SPX or even SPY or QQQ. And that's why we want to look at ETF options for some traders in this particular space. If you're trading with an account under $50,000, you generally want to look at SPY and QQQ because they provide the same liquidity and depth as SPX and NDX, but they're simply better suited for smaller account sizes.